Center stage Fibonacci trading tips and tricks. Center stage Fibonacci trading tips and tricks. We are on a monthly chart of Williams Companies Incorporation, and we can see that this stock was trending from 2009 up to mid 2014. And then it start going down. Okay, you can see that from this point it went down one more time, rally up a bit, and then now it came back down. All right, talking about center stage Fibonacci trading tips and tricks. The levels that we want to watch, the Fibonacci key levels that we want to watch, are the 50% Fibonacci retracement level and a 61.8% Fibonacci retracement level. Okay, so this is the 50% Fibonacci retracement level, and this is the 61.8% Fibonacci retracement level, this zone here. You need to pay attention. If you have watched a video that is that sounds similar to this, be careful. Stay tuned, all right? But what we're going to discuss here, there are a few things that we want to pay attention to. We want a trending first, so we can see that this stock was trending from 2009 up to mid 2014. So we want to see first a trending first. Very, very important. And then we want to see the price coming down and cancelling completely the trend. So what do I mean? So if I put a vertical line at the beginning of the trend and another vertical line at the end of the trend. So here it is, this is the trending period of this stock. Now it starts coming down, 1, 2, 3 down, okay? We want the correction, all right, or the pullback to cancel the trend. So the trend has started here, okay, right here, the trend has started here. Now the correction or the pullback has also canceled the trend. So in order to apply what I call center stage Fibonacci trading tips and tricks, we want to see a trending first. The second condition, the pullback must cancel the prior trend. Once this condition is completed, we will now apply the Fibonacci retracement to the trend. So this is the Fibonacci retracement to the trend, and we will highlight the 50% Fibonacci retracement level, and also we will highlight the 61.8% Fibonacci retracement level. Okay. If the financial instrument, after cancelling the prior trend, rally up to the zone of 50% and 61.8% Fibonacci retracement level, where my cursor is, this is a bearish trade setup. So at this point in time, what we can say to traders, priority to bullish signal above the level of 50% Fibonacci retracement level, and priority to bearish signal, okay, below the level of 50% Fibonacci retracement level. Are you following me? The center stage Fibonacci trading tips and tricks, a trending first, followed by a correction or a pullback that has canceled the prior trend. If now we will apply the Fibonacci retracement to the whole trend, and if the price rally up to the zone of 50% and 61.8% Fibonacci retracement level of the prior trend, all right, of the prior trend, so you apply the Fibonacci retracement level to the prior trend, not to the correction. If you rally to this zone, we want to give priority to bullish signal above the 50% Fibonacci retracement level, and we want to give priority to bearish signal below the 50% Fibonacci retracement level. So if the price, as you can see now, is going up, it didn't reach that level here. If you reach that zone, we will implement a top-down trading method, looking for an opportunity to sell below, okay, the 50% Fibonacci retracement level. This is a high probability trading setup. Why? Let me explain it to you. If we have a trending first, okay, and the financial instrument start pulling back or a correction has begun, usually, so a bullish trend and a correction has begun, and the pullback reaches the 50% and the 61.8% Fibonacci retracement level, there are always orders here to buy the stock. A lot of orders here are already placed here as the correction started to buy the stock. So for one reason or another, those orders has failed. So the orders were filled, but the bearish traders managed to sell the stock beyond this zone. This zone here between the 50% and the 61.8% is what we call the sweet spot zone, sweet spot Fibonacci trading zone. Remember that because we have a bullish trend before, now the price pull back into the sweet spot zone. This area generally, very often, is packed, so to speak, with orders to buy this financial instrument. Those orders, though they were filled, the bearish traders managed to sell and forces the price beyond that level. So the financial instrument become truly bearish. So remember that those who place their orders here to buy first has lost money because that order were filled when the price reaches this level. But unfortunately for those traders who did not use a top-down trading method to trade here, they did not forget that they lost here. All right, they remember that they lost here. So they placed order here to buy before, and they lost. And they don't forget it, okay? It's a psychological effect that they receive at this point in time in the zone of 50% and the 61.8%. They want to buy, they bought it, but it was a losing trend, a big losses took place here, all right? Now, as the price continues to go down, there is another level. The smart investors, long-term investor, also will place order at 78% Fibonacci retracement level. So those who bought it at in the zone of 50% and 61.8% lost money. There is another group of market participants that are always buying at 78.6% Fibonacci retracement level. Personally, I always use exactly 78% instead of 78.6%. So orders are placed here to buy again the same financial instrument, because if the financial instrument really reaches the level of 78% Fibonacci retracement level, is considered as oversold. Theoretically speaking, generally speaking, is considered as oversold. Now, the best approach for technical traders is to use a top-down trading method as the price reaches the level of 78% to manage the risk instead of buying like old-fashioned traders. But remember, those who bought it first lost money in the zone of 50%, 61.8%. Once again, those who place orders at 78% Fibonacci retracement level, if they do not use option or the time period has expired for their option, they lost money. If they do not manage their trade carefully here, and they don't have a deep pocket, they may lose money also. So we may say those who bought it in the zone of 50% and 61.8% lost money, and those who placed orders at 78% also lost money. So there are a lot of market participants that has lost money because the stock went down and canceled completely previous gain. It's a psychological effect. For those reasons, as the price going up and reaching the same zone, which is the 50% and 61.8%, when the first buyers lost money, this time they don't want to buy anymore. They want to sell because they remember that though they would bought it here and they lost money. So they would prefer to buy above that zone. They are careful. So instead, they will as the price see deep below the level of 50%, 61.8%, and also below the 78%. Now it start going, now you see now it's at 78%. If you continue to go up and reach this level, I can tell you now, my friend, for this stock, Williams Company Incorporation, orders are already packed here to sell. Orders are already packed in the zone of 50%, 61.8% to sell it, because we have a total cancellation and the price is now returning into the zone of 50% and 61.8% Fibonacci retracement level. Very often you'll see the stock will stagger here. If it's going to be truly bullish, it may stagger here for a while before it may break above this particular zone. Or sometimes the price will pull back, forming a double bottom chart pattern before going up. This is about center stage Fibonacci trading tips and tricks. If you have any question, put in the comment section. Any suggestion, put in the comment section. And in due course, we will record another video to answer your specific question. To summarize this video, we want two conditions, okay, to be fulfilled: a trending first and a pullback that will cancel the trending first completely. Once that condition is fulfilled, we apply the Fibonacci retracement and we will highlight the 50%, the 61.8% Fibonacci retracement level. Because the previous gain was completely erased, market participants lost money in the zone of 50%, 61.8% Fibonacci retracement zone, and also in the zone of 78% Fibonacci retracement level. As the price rally up into the sweet spot zone, sweet spot Fibonacci zone, this area, this price level is packed already with orders to sell, and there is a high chance that the stock will continue to go down, forming a double bottom chart pattern. For stocks that are quite resilient, it may stagger here in the zone before, it may take them some time before they break above the 50% and 61.8%. Remember the first two conditions. The opposite, though, the example that I'm giving you here is during after a bullish trend. It's also true in a downtrend. When you see here, we have a bearish trending phase, and then we have a correction that brings the price back to the starting point. The same rule apply. We'll apply the Fibonacci, okay, retracement to the trending phase. Very, very important, to the trending phase. And we will highlight again the 50% and the 61.8% Fibonacci extension zone. All right, so a total retracement after a bearish trend, so price went down all the way here, and the correction has cancelled it. Now, what we will expect if the price starts coming down after a total retracement, these two conditions: trending first, total cancellation, the price pulling back. If it reaches again the zone of 50% Fibonacci retracement level, you can bet that this zone is packed with orders to buy the stock, and there is a high chance that the stock will go back up, forming a kind of a double top chart pattern before going down. All right, or it may stagger here for a while before it continues to go down, because this area will be packed with orders to buy. Remember that in this case, as the price went down, you see it went down like this and starts pulling back. If it reaches the zone first, there were orders here to sell, because it's a bearish trend, okay? It's the opposite of what we discussed already here. So there were orders here to sell. Those orders have fell. The bearish sellers here has fell. Those who place order 78% also has to sell. They have also endured losses. So therefore, as the price starts pulling back into the zone of 61.8%, 50% and 61.8% Fibonacci retracement level, these orders, this zone is packed with orders to buy. This is about center stage Fibonacci trading tips and tricks. We are the TSTW24 traders talking about center stage Fibonacci trading tips and tricks. Happy trading to you all, and speak to you soon.